Welcome to 1 Minute Finance, your quick shot of business wisdom.
Welcome to our channel. In today's video, we're diving into the world of REITs, real estate investment trusts. If you're curious about investing in real estate without the hassle of owning property, REITs could be a powerful option. Let's break down what they are, the different types available, potential returns, and the risks you should be aware of. What is a REIT? A REIT is a company that owns, operates, or finances income-producing real estate. These companies pool money from multiple investors to buy and manage properties like shopping malls, office buildings, apartment complexes, hotels, and even data centers. The key advantage? REITs offer a way for everyday investors to access large-scale income-generating real estate without buying property themselves. Types of REITs. There are three main types of REITs. First, equity REITs. These are the most common. They generate revenue primarily through renting out properties and collecting lease income. Second, mortgage REITs, or REITs. These invest in real estate debt, earning money from the interest on mortgages and mortgage-backed securities. Third, hybrid REITs, which combine both equity and mortgage strategies, offering exposure to property ownership and real estate debt. How do you earn from REITs? REITs make money through rental income, property appreciation, and interest from loans. As an investor, you benefit mainly from dividend payouts, often higher than average because REITs are legally required to distribute at least 90% of their taxable income to shareholders. What are the risks? Market can affect property values. Rising interest rates can impact profitability, especially for mortgage REITs, and economic downturns can lead to lower rental income and higher vacancy rates. Why choose a REIT over buying property? REITs offer liquidity, since many are publicly traded, and can be bought or sold like any stock. They also require low investment, offer diversification, and are hands-off, meaning you don't deal with tenants, repairs, or property management. How do you invest in a REIT? Publicly traded REITs can be bought and sold on stock exchanges, just like any stock. You can purchase them through your brokerage account, inside your retirement account, or as part of a mutual fund or ETF. This makes REITs one of the most liquid ways to invest in real estate. You don't need hundreds of thousands of dollars or months of research, just a few clicks, and you're in. However, unlike direct ownership, you have no control over which properties are purchased or how they're managed. And since REITs are traded on stock exchanges, they can be more volatile than real estate itself. What returns can you expect? Historically, REITs have offered strong dividend yields, often higher than what you'd find with typical stocks or bonds. In addition to those dividends, your investment can grow if the REIT's share price increases. That happens when the value of its properties rises, or when its rental income grows over time. Many investors choose REITs to generate passive income or diversify their portfolios beyond stocks and bonds. Also, not all REITs are created equal. Some may be less transparent or take on excessive debt. REITs can be a great way to diversify your portfolio and earn passive income. But before investing, it's important to do your research. Understand the type of REIT you're buying into, and consider how it fits with your financial goals. Thanks for watching. Don't forget to like, subscribe, and hit the bell so you never miss an update on smart investing strategies.